Cost accounting is a term that might sound a bit dry at first, but trust me, it's anything but boring. Imagine running a business, whether it's a cozy little bakery, a tech startup, or a manufacturing giant. You want to make money, right? But how do you know if you're actually making a profit? This is where cost accounting steps in, like a trusty sidekick, helping you navigate the sometimes murky waters of business finances. So, what is cost accounting? At its core, it's all about tracking, recording, and analyzing the costs associated with running a business. It's a way to gather all that financial data and make sense of it. Think of it as the GPS for your financial journey. Without it, you might end up lost, overspending, or underpricing your products. Let's break it down a bit. Cost accounting involves classifying costs into categories like raw materials, labor, and overhead. This classification is crucial because it allows you to see where your money is going. For instance, if you're running a bakery, you'll want to track how much you're spending on flour, sugar, and labor. This helps you understand the cost of producing each cupcake or loaf of bread. Now, there are various methods for assigning these costs. You can trace costs directly to individual products or allocate them based on sales volume. For example, if you bake 100 cupcakes, the cost per cupcake will be different than if you bake 10,000. This is where things get interesting. Understanding these costs can help you make informed decisions about pricing. Let's say you're trying to decide how much to charge for that chocolate cupcake. If you know that it costs you $1 to make each cupcake, you might want to price it at $2 or $3 to ensure you're making a profit. But what if you find out that your competitor is selling a similar cupcake for 50 cents? That's where cost accounting becomes invaluable. By analyzing your costs, you can figure out if you can lower your price without sacrificing your profit margins. But cost accounting isn't just about pricing, it's also about evaluating performance. Picture this. You're looking at your monthly sales report and notice that you've sold 1,000 cupcakes, but your costs have gone up significantly. Cost accounting can help you pinpoint where those extra costs are coming from. Maybe your flour supplier raised their prices, or perhaps you're wasting ingredients in the kitchen. By identifying these trends, you can make changes to improve profitability. Now, let's take a step back and look at the history of cost accounting. It really started to take shape during the Industrial Revolution, when businesses began mass-producing goods. Companies realized they needed a way to manage not just direct costs like materials, but also indirect costs like overhead. This led to the development of various cost accounting systems, such as job costing and process costing. Fast forward to today, and cost accounting has evolved even further. With advancements in technology, businesses can now use sophisticated software to track costs in real time. This means you can get instant insights into your spending, making it easier to make quick decisions. But why should you care about cost accounting? Well, whether you're a small business owner or a manager in a large corporation, understanding cost accounting is crucial for success. It helps you allocate resources effectively, identify opportunities for cost savings, and ultimately improve your bottom line. Let's talk about some specific examples of how cost accounting can be used. One common application is budgeting. By analyzing historical cost data, you can create a budget that reflects your business's actual needs. This can help you avoid overspending and ensure you're allocating resources where they're needed most. Another area where cost accounting shines is in evaluating potential business ventures. If you're considering launching a new product line, cost accounting can help you assess the costs associated with that venture. By understanding the potential return on investment, you can make informed decisions about whether to move forward. Now, let's dive into some key concepts within cost accounting. You've probably heard terms like fixed costs and variable costs. Fixed costs remain constant regardless of production levels. Think rent for your bakery space. Variable costs, on the other hand, fluctuate with production levels, like the cost of ingredients. Understanding these distinctions is essential for accurate cost tracking. And what about direct and indirect costs? Direct costs can be traced directly to a product, like the flour used in your cupcakes. Indirect costs, however, are more challenging to allocate. These might include utilities or salaries for staff who don't directly produce the goods. Cost accounting helps you allocate these indirect costs appropriately, giving you a clearer picture of your overall expenses. Let's not forget about the cost accounting cycle. This is the process businesses use to track expenses and calculate the cost of goods sold. It starts with recording data on raw materials and labor, then classifying those costs, and finally analyzing the data to make informed decisions. It's a continuous loop that helps you stay on top of your financial health. But what about the differences between cost accounting and traditional accounting methods? Traditional accounting focuses on external reporting, providing a snapshot of a company's financial health for investors and stakeholders. Cost accounting, however, is more internal and focuses on providing managers with the information they need to make operational decisions. Now, let's touch on some advantages of cost accounting. First, it's highly customizable. Every business is different, and cost accounting allows you to tailor your approach to fit your specific needs. Additionally, it provides accurate information for decision-making, enabling you to make informed choices that can save your business money in the long run. Of course, like any tool, cost accounting has its limitations. Not every business needs a full-blown cost accounting system. For small service-based businesses, for example, the costs may be straightforward enough that the added complexity isn't necessary. Additionally, implementing a cost accounting system can be costly in terms of software and training. Now, let's talk about the various types of cost accounting. You've got standard costing, which assigns standard costs to goods, and activity-based costing, which allocates costs based on specific activities. Lean accounting is focused on minimizing waste, while marginal costing looks at the cost of producing one additional unit. Each of these methods has its place, depending on your business model and goals. And what about the role of a cost accountant? These professionals are essential in tracking costs and providing valuable insights to management. They help ensure that businesses are making informed decisions about pricing, product mix, and investments. In conclusion, cost accounting is an invaluable tool for any business owner or manager. It provides the insights needed to make informed decisions, optimize operations, and ultimately improve profitability. Whether you're just starting out or looking to refine your existing processes, understanding cost accounting is key to navigating the financial landscape of your business. So, next time you hear the term cost accounting, remember that it's not just a bunch of numbers. It's a powerful tool that can help you achieve your business goals.